Good morning, ladies and gentlemen. A very warm welcome to you on Business Today Television. We are showcasing the finest fund manager talent on Dalal Street at the moment, and we are delighted to welcome Mr. Mihir Vora, Chief Investment Officer at Trust Mutual Fund. This is a recently set up AMC which is doing phenomenal work both on the flexi cap space as well as the small cap space. A very warm welcome to you, Mihir, and as usual, the returns on the small cap fund, which has completed 1 year, 12 months today, are phenomenal. It ranks first amongst 49 funds with a return of about 22%. That's great going.
Thank you, Shailendra. Always a pleasure to be on the show. And yeah, you're right. This is a good day. We've just completed first year of the small cap fund, and we're happy to take this conversation forward. Thanks for having me.
Okay, so what we'll do is we'll keep the viewers waiting a bit as far as what the small cap details are concerned. But let's just understand at this point of time, Mihir, what do you think is Dalal Street doing at the moment? We've had a great tailwind for the month of October. It's a quiet start to November. Data both on the macro front as well as on some green shoots as far as earnings are concerned is pretty good. How comfortable are you with the way Dalal Street is moving at the moment?
So, Shailendra, I would say that we are in a bit of a consolidation mindset, I would say, as far as the markets are concerned. Okay. And that's because of a couple of factors. So one is, of course, that from the bottoms, we have bounced quite smartly. If you remember the situation in March, what it was, and after that, you had the big, blow of Trump tariffs. And of course, there was a general slowdown, etc. So there were a lot of India-specific headwinds in the last 6 to 8 months. But the markets did bounce back very smartly in spite of all those, headwinds. So to that extent, I would say the market performance, while on a 1 year basis, it looks like most of the indices are flat. But we have been quite resilient in the face of adversity. And that's what is the long-term hope for India, that, India is a very anti-fragile country and we are very adaptable. We are an open economy and we can withstand shocks based on the inherent strength of the domestic economy and, more importantly, the domestic consumption story. So I think that long-term story has been proven that we are quite resilient in spite of shocks being proffered onto the economy. In the medium term, I would say that there are a couple of factors which will keep the markets volatile. First is that the US is in a question mark. So we are not sure whether inflation is going to hurt more or whether, the US economy will generally go into a slowdown cycle because of the excessive debt buildup. Plus, there is this huge government shutdown that's happened for the last 35 days. So I think US is a question mark. China is a question mark. So while the recent performance of the tech stocks in the US has covered up for a lot of the weaknesses in the broader economy in the US, the fact remains that it's only 7 stocks which have held up the US market. It's mostly the tech stocks. And for the first time in many months, I am seeing a debate on whether valuations of the tech stocks, especially the AI-linked stocks, whether it's kind of into a bubble trade or not. So in the last 2 to 3 days, we have seen some kind of volatility because of that debate. The fact also remains that a lot of the growth in AI is coming because of circular deals, companies investing in each other. There's a lot of debt that is being built up to set up data center and AI processing capacity. And those to some extent are being now questioned as to the rate of growth, whether that can be maintained. So we have a bit of uncertainty in the US and China. In India, while the government has done a lot, especially in the GST cuts and the budget income tax cuts, so that has spurred consumption, and you did really see a good leg up in consumption in the month of October. But the question is now whether this momentum in consumption will sustain into the next 2 or 3 quarters, the second half of the financial year FY26. So stocks have done well. We have been resilient, very good. Long term looks good. Short term, I would say a little bit of wait and watch to see whether the consumption story pans out, whether the trade tariff deal works out in the next couple of months, because I think that's a big trigger. If it gets delayed, then it will be a sentimental negative. And finally, we do need FIs to come and start buying in the market. We've seen enough of selling for a long period of time, and I don't think the markets on a standalone basis, while domestic flows and all is fine, but we do need that tailwind of FII flows. So I would say good setup, but a wait and watch mode.
Right. Mihir, the fund as well as the AMC has been on a shopping spree as far as September and October is concerned. Overall, the number of stocks has risen dramatically. That means new positions have been taken up by Trust MF. But what's really interesting is that amongst the top two holdings, which is the two private sector banks, there has been a bit of a trim that has happened. Any reason why you feel profit booking was necessary in the private banking space?
It's been a small move. I would not say it's significant enough for us to have taken a call. It's just a bit of tweaking, I would say. So, in general, over the last 6 to 12 months, we have been, underweight on the banking system and overweight in the non-banks and the capital marketplace. So, to that extent, we have done a little bit of reshuffling. We have added public sector banks to the portfolio. We have added some of the smaller private sector banks to the portfolio where we thought valuations are happening, and plus there was a bit of a possibility of strategic sale, etc. also. So I'm in general positive on the private sector and the public sector banking space now compared to before, and that's where we have been aligning the portfolios. Capital marketplace we have reduced a little bit because overall you need to keep the balance. So we've shifted a bit in favor of banks, I would say. NBFCs we continue to be positive on.
Yes, there are fresh entries on two public sector banks, the largest one as well as the one that's hit a record high, Indian Bank. At this stage, Mihirji, where is the valuation matrix in terms of probability of longer term gains? Is it still with the public sector space? For instance, a record high on SBI, a record high on Indian Bank. Do you still feel the PSU banking space is worth a trade on the long side?
Yes, I think there is juice in both the segments. It doesn't have to be a either or kind of a situation, and I tell you why the situation is like that. First of all, for the longest time, we've been saying that valuations, as far as Indian banks are concerned, have not been an issue for a long period of time. So I think, given the kind of growth potential that is there and the underperformance of banks in the last 1.5 to 2 years, makes them relatively quite attractive as far as valuations are concerned. The only thing that was missing was growth. And in this quarter, if you see the September quarter numbers, we have seen some small green shoots of growth happening in the credit growth. For example, one of the largest public sector banks actually has beaten the industry and has grown its loan book faster than some of the leading private sector banks also. So what used to happen is earlier there used to be a big delta in the growth rates of private sector banks and public sector banks, where private sector banks used to grow far more compared to the PSU banks, and that was predominantly led by retail credit growth, whether it's secured or unsecured, both put together. But the growth for the last 5 to 7 years in the private banks has come from retail credit. Corporate credit, of course, is something that they did not enhance too much. What is happening is now that the retail credit growth has come down for various reasons. We can talk about that later. But MSME and corporate credit growth seems to be picking up, and that's where I think that the public sector banks are in a bit of an advantage, and that's why we are seeing that the delta in growth, the differential in growth between PSU and private banks has reduced. That's why I think the valuations are attractive in both the cases, but it's no longer a case where we would prefer completely private sector banks over public sector banks. The equations are well balanced on both the sides.
G. So that's the view that, ladies and gentlemen, is on the PSU banking sector. You've, Mihir, also pointed out the strength or the comfort that you feel with the NBFC space? The tailwinds, of course, we've discussed. Where does momentum and value lie in the NBFC space? Are you looking at sector leaders or are you looking at mid caps?
In NBFCs, we are still sticking to some of the larger ones. So we have the largest NBFC, which is more focused on the retail space. And we also have the largest gold finance NBFC, which I think is in a secular growth phase. So there in NBFC space, we are sticking to mostly the leaders. And in the small cap and the mid cap fund portion, we have some of the smaller, affordable housing plays, etc., in the NBFC space.
Okay, fair point. Now let us look at what you've been avoiding and what sort of remains, untouchables. There is an entry of a mid-cap IT company, which is pretty well known in the market, but large caps continue to be missing. Is this a space that you are still not comfortable with? Which is large cap IT?
Yes, and that is more a function of our philosophy and approach rather than anything else. We tend to look at long-term high growth secular plays. In my view, the large cap IT companies, if they continue with their current business models, are not going to be high growth plays. They will be more of the 5 to 10 to 11% growth rate plays for a long period of time. And if you look at our overall portfolio, the earnings growth rate, the top line growth rate on an average, weighted average basis is almost 30% for our portfolio. So the large cap ITs really don't look that attractive to us from a growth point of view. And we believe that growth comes first. Of course, valuations are important, but as long as growth is there, valuations will take care of the I would say the returns that we generate. So in IT, we have always preferred bottom up plays in the mid cap space. We have two to three mid cap IT companies which have been demonstrating quite high growth rate compared to the large cap peers, and that's where we are betting on.
Right. Mihir, my final question on the broader AMC, then we'll shift focus to the small cap fund. Two new entrants have come into the MNC from the auto space. The largest passenger car maker and of course the biggest maker of heavy end motorcycles. Now the rate cuts were announced in August when the rally started in the auto space. At these levels, do you find comfort in Maruti or Eicher or even the broader auto OEM space?
So we did increase the exposure to auto OEMs, especially the four-wheelers, based on the GST cuts, and that's worked for a while. But now, as we discussed in the beginning, now it's a question of whether this momentum will sustain for the next half of the year. So because that one bunching up of demand because of that excitement and buzz created around Diwali, GST cuts, etc., has played out. But of course, now we are into the harvesting season. Farmers and consumers will get money in their hands to spend, and there is a shadi marriage season also. So all those busy season things will pan out in a cyclical way, and now we'll have to wait and watch how things pan out. But I would say that if I were to look at secular stories in the auto space, they are still in the auto ancillaries, because there are a lot of things to play in the auto ancillaries. One is the premiumization segment. So a lot of accessories are being built into the cars and two-wheelers. A lot of value-added stuff is being done. Designs are getting changed, and they all require auto ancillaries to scale up. And the value-adding component per vehicle, whether it's a two-wheeler or four-vehicle, is going up all the time. Electronics is going up all the time. So in my view, I would say that the secular growth plays are in the auto ancillary space, and that's where we have the maximum overweight position.
Right. Let's also shift focus now to the Trust Mutual Fund Small Cap Fund. Ladies and gentlemen, this is a scheme that was launched about 12 months ago, and the fresh data is upon us. If you look at the returns, they've been fantastic. a corpus of about 1000 crore rupees, and the 6 month returns, ladies and gentlemen, are 22.2%, and the returns since launch, which is a 1 year period, is 12.3%. Mihir, the last 6 months, of course, have been phenomenal. What were the 2 or 3 reasons that drove this kind of a performance in the small cap fund?
Sure. So, it was a very interesting time when we launched the small cap fund. That was the last quarter of last year, when there was extreme skepticism about the market, about valuations, about there being a bubble in the small cap space, etc. So we did face a lot of questions when we launched the fund. But we were very clear when we launched the fund,
Yes.
which is that there are enough stocks to choose from all the time in India. If you look at the number of stocks with a market cap of more than 2,000 crores in the stock market, there are almost 1,000 to 1,100 stocks to choose from. Even if you remove the top 100, which are large caps, the next 150, which are mid caps, there is almost 8 to 900 stocks to choose from in the small cap universe. And to build a portfolio of 50 to 70 stocks, which still offer value, we believe was a task that was not easy, but not impossible either. So it was with that strong conviction that we launched the small cap fund. So if you look at the attribution analysis for the last 6 months or the last 12 months, it's basically because of stock picking. We are very focused on growth. We are earnings growth. We are very focused on long-term earnings growth, and we believe that if we get the right stocks, even if we pay a little bit of premium based on current earnings, it's fine as long as the earnings growth is superior. So consistently, if you look at the last 12 months, our portfolio weighted average earning growth for the portfolio companies has been far, far higher than the market profit growth. Optically, the P ratio also may look a bit higher, but that's more than
Okay.
compensated by the higher earnings growth in the portfolio. So I would say it's been a lot of stock picking that has helped us. And it's not stock picking in any one particular sector. It's been across the board. If I were to look at my top contributors, it's the top contributor is a auto ancillary. The second top contributor is a plastics fine, very high precision plastics engineering companies. The
Yes, that
third
was
top
highlighted.
contributor in terms of attribution would be a defense company. Then we have a power T&D company. Then we have a chemicals CDMO company. Then we have a new age online car consumer platform. Then there's one more defense company, another auto ancillaries company. So it's been a lot of stock picking, I would say, that has helped us, and that's been across sectors. But the common characteristics that all these have is that all these companies have very high growth potential for a very long period of time. And that's what the whole crux of our original investment philosophy that we follow, which is growth at reasonable valuations with terminal value investing as the, I would say, as the North Star.
Okay, ladies and gentlemen, just for the sake of convenience to everybody, Mihir has mentioned the sectors in which the top 5 holdings are. I'll name them because all this is public data. Karur Vyasa Bank is the top holding with about 2.6% of 1,000 crores allotted to it. What is also interesting is the next one. This is from the transmission and distribution space, GE Vernova, and the plastics energy company that Mihir referred to is Shaili Engineering, 2.5% of the portfolio. MCX follows next. This is 2.5%, 2.4% of the portfolio. Then you have liquor company Radico Khaitan, IT company KNS Technologies, and then the auto ancillary Lumax Auto, followed by defense company Apollo Microsystems. What is also interesting me here is that the overall cash component of the portfolio is about 7.5%. Is this a deliberate call?
The cash tends to be between 3 to 7% typically. But as of now, it's not a cash call per se. At the month end, we might have sold some stocks in the to buy something else. So it's not a defensive call, I would say. It's just a tactical working capital, I would say.
Okay. Okay. 66 stocks in the portfolio. Is it about enough, or is this a moving target? In the sense, some of the top performing small cap funds have more than 100, the top two have more than 200. Are you comfortable with 66?
Absolutely. I think the sweet spot is somewhere between 50 to 65. And that's the aim that we have, launched the fund with. So if you look at all our funds, whether it's a flexi cap fund or our multi cap fund or the small cap funds, the number of stocks is somewhere between 60 to 65 typically. And that's, I think, the sweet spot of between over concentration and over diversification.
Okay, fair point. And the price to book at the moment is somewhere like 5.1, a bit on the higher side, but then if you're getting performance out of it, then why not? And the overall portfolio PE 42. Of course, the small cap space does have very expensive stocks, as also those trading at pretty high valuations. Are you comfortable with this, or would you like to bring it down?
We are absolutely comfortable. As I said, just a little while back, our weighted average portfolio earnings growth tends to be very high. So if I look at the next couple of years of earnings growth for our portfolio, it's somewhere between 30 and 35%. And if I look at the FY27 price to earnings multiple, that's also somewhere between 30 and 35. So on a forward basis, adjusted for growth, our PEG is actually quite close to one. The PE to G ratio is quite close to one. So one never looks at the PE ratio on a standalone basis. It has to be seen in context of growth. And to put things in perspective, the index itself has a growth rate of less than 20%. It's about 15% or so. So compared to the index, our growth is more than double, and the valuations are not more than double. So the index peg is actually far higher than our peg. So I think we are doing fine as far as the growth adjusted valuations of the portfolio is concerned.
Okay. A fresh entrant in the small cap portfolio is a very well known mid cap hospital stock. At this level, Mihir, does valuation for hospital stocks, which have more than doubled in many cases in the last 3-4 years, still attract you?
Certainly, because we are looking at compounding of earnings growth for the longer term. So there will be, times of overvaluation, there will be times of undervaluation. But we've seen that if there is a secular earnings growth, your entry timing is less important, but the time that you hold the stock becomes more relevant. So in the hospital space, we have, I think, my view is that we have short supply of everything all the time, especially good quality hospital care. And that's going to be a big theme going forward because the government is obviously not able to supply the kind of quality and quantity of healthcare that is required. It has to be done by the private sector. And with rising affluence, pricing actually is not a problem. So you see hospitals being able to charge quite high premiums for the kind of services that they provide. So there is pricing power, there is volume growth, and there is a permanent shortage of good quality healthcare. So that's the big secular theme that we are following.
Okay. And the final question, Mihir, and this I have deliberately kept for the last. Silver and gold have come off their high horse and are showing a nice, decent bout of correction on the charts. Is the best for silver and gold behind these precious metals, or are we going to see fresh rallies?
I think the best, in the sense, percentage CAGR that we've seen in the last 3 years probably may not be seen in the next 2 to 3 years. But whether I see them being higher 1 year or 2 years down the line, I see definitely yes. Because the core thesis for buying gold and silver has still not gone away, which is the fact that the Western world, especially the US, Europe, will have no choice but to print their way out of the debt problem. So the currency debasement theme continues, and that's when precious metals like gold as a store of inflation, as a store of value and a hedge against inflation, that thesis continues. So I think we are fine on that, and as we have discussed in the past, Indians holding the largest quantity of gold is going to be immensely beneficial for the Indian population and the consumer.
Right. And the last question, Mihir, is there anything that's bothering you in the markets? We have 4 or 5 major tailwinds. There are green shoots in the valuation space, but anything that you don't like at the moment?
So the key that we are watching for is sustenance of this consumption spike that we've seen. Second is private sector capex, as you just mentioned, are showing some signs of green shoots, but we need that capex to accelerate much more in terms of reducing the trade deficit as well as in terms of boosting the trade deficit. And that, of course, means that banking credit has to pick up for corporate purposes, not only for retail purposes. And the third is, of course, we need to sign the trade deal sooner rather than later, because without that, the sentiment overhang will always remain in the market. So these are 2 or 3 of the things that I want to get resolved, or I want to see accelerating in the next few months.
Right. With that, Mihir, as always, it's such a pleasure to host you. We look forward to another conversation on the FlexiCap scheme, which was the first product that Trust Mutual Fund launched in 2024, early part of it. Here's wishing you all the best, and let's hope that the end of 2025 is far better than what the first 8-9 months have been. Thank you for being with us.
Thank you, Shell, for having me. All the best.
That, ladies and gentlemen, was the Chief Investment Officer, Mihir Vora, at Trust Mutual Fund Asset Management Company. Something that has been set up over the last 20-25 odd months, and 2 of their products, the FlexiCap scheme and the Smallcap scheme, have outperformed the broader market. Thank you for joining us. Please stay glued to Business Today Television. There's a lot that's happening on the other side of the break. Thank you.